My next segment was going to be about Slate Financing. Again, your expertise is in that domain, as well as the firms. I was curious about the approach towards Slate Financing. Again, there are typically VCs who invest in startups have the ones that really return the money and more. There are others that are averages that will just sort of make sure that they don't lose money, and then there are some that will not perform as well. Explain a little bit about your approach to Slate Financing, especially given the tremendous range in creative output that this industry has. How do you typically approach that and balance it out?
Yeah, I think first of all, there are many within the concept of slate financing. There's been many different definitions, right? Like you typically look at slate financing as, for example, financing the studio films, right? I had the privilege in my previous company with Ingenious to co-finance a vast amount of films with studios, from the first Avatar to the X-Men franchise to Life of Pi and so on. And of course, at that level, it was very different type of relationship. When in the definition of a studio co-finance, it's a slightly different dynamics you bring to the table. What we do with these companies, we call it Slate because we invest in more than one project. But again, it's forming a strategic relationship, a strategic alliance, so that we can collaboratively looking at the number of projects over a period of time, knowing that, especially nowadays, again, it's very binary, the results of these projects. So if you only put all the focus in the single project, you have to be either extremely lucky or extremely good at just picking that one project. But because we have a big amount of capital to deploy, we cannot just single-handedly handpick these projects from the entire market without creating synergies, without creating connections. So we create slates in the sense that we form these collaborations, and we understand that when we go into a journey with these companies, we maximize our chances of doing well. We help them strategizing over a longer period of time, right? Because some of these companies, they don't have access to that much capital as they do through the relationship with us. So knowing that they have that pool of money available, they can strategize more in terms of the project that they really want to go after and they want to finance and they want to work on. So again, it's trying to bring that best practice into the way they build their companies, or in case of bigger companies like Red Bull or A24, of course, they are very mature. They don't necessarily need access to cash, but they still might need that different point of view that we might be able to bring to the table, and their ability to strategize a bit further in the future, and knowing that they can do a bit more. They can do the extra projects or the 2 extra projects, and they can take a bigger risk. They can finance something like Marty, which maybe is at the budget level that a couple of years ago they wouldn't have done it. But now they know they can take that risk. And if that risk pays off, the upside it's much larger. So again, we want to enable that risk-taking approach, knowing that there is a risk, but knowing that if it works, the type of returns you're looking at are much more similar to other private equity style funds. In the way you were describing the portfolios, venture capital is in our name, and some of the things that we do are in the VC spirit. But I think in film and TV in particular, that range of returns and downside is not as vast as in venture capital, because you kind of know that working with certain companies, your downside it's relatively more secure, and your upside is still uncapped. You can still deliver very good results, but you're not necessarily chasing unicorns to justify the risk you're taking on your whole portfolio. You're just looking for those projects that could be a good proof of concept, and in success would deliver enough to cover some other losses and some more.